All right, Chapter 16 is going to talk about the Federal Reserve System. Federal Reserve System is kind of the central nervous system of the U.S. economy. We actually didn't have a Federal Reserve System, for a long time, but we ended up creating one. It's essentially a national bank. We created one in 1913. Um, so what is the Federal Reserve System, aka the Fed? It's usually referred to as the Fed. Controls the U.S. economy and keeps it growing. The chairman of the Fed is like the president of the economy. Just less people know who he is. He's the current one is Ben Bernanke, and so a lot of people say that he's more powerful than the president because this is the person who has direct control over the economy. The president doesn't really. The president he has control to make laws, he can raise minimum wage, stuff like that, but he can't really control the money supply. And really, the money supply is what keeps our country going. So there's two things that the Fed is fighting or supposed to fight. Is one, unemployment, and two is inflation. It fights inflation by not printing as much money, and it fights unemployment by inflating the money, which is counterintuitive, right? But the two things are so related that they're just kind of so wound up that you can't separate them. This is coming from something called Keynesian economics, which advocates the manipulation of the money supply to create employment. So how the Federal Reserve System is organized is there are 7 members on the Board of Governors. There's 12 district reserve banks. The Federal Open Market Committee makes decisions about interest rates and the growth of the U.S. economy. So it decides how much of an interest they can put on money. So when they loan out money, what the Federal Reserve Bank does, essentially, is decides the price of money. And so they decide how much interest you have to pay when you get a loan, which is the price of money. So there's 7 functions of the Fed. 1, control the money supply. They try to maintain a stable money supply. Generally, inflation, they keep between 1 and 3%. Is generally what's accepted by the federal government. And so if you added $500 million to the U.S. economy, the value of the dollar would change. It would be worth less because there are more dollars in circulation. So it's easier to get the American dollar. The easier it is to get a dollar, the less it's worth. The federal government also supplies the economy with paper money, which the Federal Reserve know. Third, it clears checks. So the way checks work, and this is kind of how debit cards work too, is one, you write a check, it goes to the recipient, whoever you're giving the check to. Then it goes to the Federal Reserve Bank. Then it goes to the check writer's bank. Fourth function, holds bank reserves. Each bank in the U.S. has a reserve amount, which is they keep just a portion of the money that that people give them. And so if I give them $10,000, they'll only keep, $3,000 of my dollars on hand. Well, if everybody in that bank goes and tries to take their money out at the same day, the bank won't have enough cash on hand to cash everybody out. So that's when the Federal Reserve Bank steps in and gives them extra money. They give them the money that that they need to cash out people. In return, they have to give the federal government back that money with interest. And so the Federal Reserve Bank acts as a bank, a loaning institution, to other banks, to smaller localized banks. 5, it's supervised banks. This is it ensures like bank money. It makes sure banks aren't doing stupid, ridiculous things or taking crazy risks. It just makes sure that people have that banks are a safe place to keep your money. 6 is the lender of last resort. If a bank run occurs, which is what I was talking about, if everybody comes and tries to take their money out at the same time, then they don't have enough money on hand, you lose all your money. Well, instead of that happening, the Federal Reserve would step in and give them money. This has happened before during the Great Depression, but it's not why we invented the Fed. It's not why the Federal Reserve Bank was created. And finally, it cashes checks for the U.S. government, and it allows the government to borrow money from itself and other countries. The Federal Deposit Insurance Corporation, which is the FDIC, was created in 1933. This provides the bank deposit insurance. So if you have a savings account, it's insured up to $250,000 per depositor. Any more than $250,000 in one account, then it's not insured by the FDIC. The Federal Reserve can change how much money the banks have to have on hand. They kind of make the rules about what percentage that banks are allowed to have or must have on hand. So if they say that it has to be a higher amount, say banks have to have 70% on hand, that it essentially shrinks the money supply. Because if they have to have 70% on hand, then they can only lend out 30%. If they only have to have 30% on hand, then they can lend out 70%. That 70% then becomes part of the money supply. It essentially acts as the money supply for the person who has the bank account and for the people who borrow the money, which that 70% essentially gets doubled. Less money in the reserve, you expand money supply. Open market operations, which is buying and selling of government securities or treasury bonds. We talked about bonds earlier, last unit. Three, they can change the discount rate, which is the interest rate the Fed charges banks for loans. So if discount rates are too high, people get fewer loans, businesses stop expanding, unemployment increases, inflation decreases. Okay? So notice that unemployment and inflation have an inverse relationship. One increases, the other decreases. People get more loans. If people get more loans, if the discount rates are low, people get more loans, businesses expand, unemployment decreases, but inflation increases. And so you see there's like a fine balance between unemployment and inflation. And so the Fed tries to ease the business cycle as much as possible, so there's not like really high peaks and really low drop-offs, Really, it wants it to be a little bit more stable, a little bit more of a gentle wave than a harsh up and down pattern in the business cycle. So in general, not that all economists follow this, but in general, if the economy is experiencing a contraction, which is a low point, in the business cycle where the economy is not doing well, the economy is not doing well, the government will ease the money supply and make it easier for people to get money so that they increase employment. If the economy is rapidly expanding, they tighten the money supply or make it more difficult for people to get money, which increases unemployment. Kind of balances off the top. And if since we're messing with the natural business cycle, if you mess this up, or if you forget about something like the housing market, it can cause the whole business cycle to become, when it bounces back, it gets 10 times worse. So I mean, this is very, very important, very careful. A lot of planning goes into it. People's entire life savings can be wiped out if they make mistakes, mathematically on this. Any policy the Fed makes is called monetary policy. Um, any policy made by the U.S. government is called fiscal policy. So taxes, government, etc. Monetary policy changes the money supply.